Hello, I'm Julie Price, and welcome to Juniper's third quarter 2020 economic review. What a quarter we had following the first recession in more than a decade. The S&P 500 bounced back 20.5% in the second quarter, the biggest quarterly gain since 1988. And the time before that, 1932. Of course, the market fell 20% in the first quarter, so there was a lot of ground to be regained, but an epic reversal for sure. Some of the things I'll talk about in this quarter's video will be, of course, COVID-19 and how the various countries and industries are recovering around the world, and what's going on with the stock market. Is this a bull market or is this a rally in a bear market? Congress is working on the next fiscal response, another massive relief bill. What will be in it, and how are we going to pay for all this? As I talk through the slides, feel free to pause and read through the charts to help get a better understanding. My goal is to present meaningful and timely information on markets for all levels of financial savviness. So let's get started. Here is the matrix through June 30th. Fixed income was the only positive asset class, along with, of course, cash, up 6.1 year to date. It's been a place of safety with stock market volatility. Large cap U.S. equity is only off 3.1%, followed by the asset allocation blend of 60% equity, 40% fixed income, which is down 4.6%. High yield bonds are down 4.7%, which are closely correlated to U.S. equities. International equities, emerging and developed markets are next, with small cap U.S. equities, real estate, and commodities rounding out the laggards. So a tough year so far, but a much better report than last quarter. This chart shows us where we're at in the current cycle, down 8% since the peak of the market February 19th. Now from January 1st, we're only down 3% year to date because the market prospered quite well in the first several weeks of the year. But this chart is looking back to the market's peak, and it illustrates how deep the market dipped in March and how well it's recovered already. It was like jumping off a cliff onto a trampoline. All of the sources that I've been following feel that we've hit our low already, helped out of it with the enormous fiscal and monetary response. So what are we seeing here? Have we priced in too much recovery? Is the bull market back? Or is it a rally within a bear market? A bull trap? How can we know? So let's look at past recessions for clues. We went over this chart last quarter, which shows the newest edition, number 13 here, the COVID-19 global slowdown. Here you can barely see the dark gray line dip down to 34%. The average bear market return is off 42%. The average duration is 22 months. This one, we don't know for sure, but we may already be in the recovery stage. More on that in a few slides. There were a couple of characteristics that were prevalent this time. Strong retracement and market breadth. We saw strong retracement in that there were more losses regained in a shorter time period than in the past. And that's what it looks like here. Very brief dip. Market breadth refers to more stocks going up than down. There were two recessions that were the exception. Number 1 and number 2 here. The 1929 Great Depression and the 1938 recession. It's difficult to see in this chart, but these two cycles also had bear market rallies too, but with stark differences, with war, currency devaluation, and how the Fed handled monetary policy. A very different environment than what we find ourselves in today. I think the lows are behind us, but I'm not expecting smooth sailing ahead of us either. We are not guaranteed a bullish outcome, but looks like the bull may be back. Looking at the S&P 500 again, I know that this is really looking like a V-shaped recovery, but the right side of the V is still waiting for a sign that the pandemic is getting under control. So maybe it's more of a V-interrupted recovery. I think we're going to bounce around here a bit until the market gets a sense of the end of the pandemic, a widely distributed, successful vaccine. And that's when I think we're going to see recovery with so much pent-up demand for travel, entertainment, restaurants, and retail. And the recovery that we've gotten so far, it's been quite promising. We see our most recent recession in gray here, an estimated decrease in real GDP of 12.8%, one of the biggest drawbacks in GDP over the last century. The official announcement of the recession was made by the National Bureau of Economic Research on June 8th. But by that point, although not official, we were likely on the road to recovery. It's just not seen in the reports from retailers, airlines, and car dealerships. The typical definition of a recession is 2 consecutive quarters of negative GDP growth. First quarter GDP was down 5%, and second quarter's GDP will be released on July 30th. JP Morgan estimates that it will be down 35%. What a doozy that will be. They're also estimating third quarter GDP to be up 20%. So if we have a positive quarter of GDP in third quarter, we could say that the recession is over. But we won't get that figure until the end of October. Here's a look at the price-earnings ratio at a whopping 22 times earnings. It's more than 1 standard deviation above its 25-year average, up in the tech bubble territory that burst in 2001. With record low interest rates, the high valuation of stocks look more reasonable. When bonds are not yielding as much income, investors tend to shift towards stock, driving up the PE ratios. Looking at annual corporate profits, the green bars are years in which earnings of the S&P 500 are declining, called earnings recessions. The gray bars are years where they are accelerating, and they accelerated sharply in 2018 because of tax reform, but leveled off in 2019 due to slowed global growth and a strong dollar. So then here comes COVID and oil, and 2020 earnings come under pressure. But what do earnings look like for 2021 and 2022? Stronger. And that's why the stock market is doing better than we are feeling right now. When you buy a stock, you're buying 15 or 20 years of future income. Investors are seeing it as one bad year ahead with stronger years in the future. On the chart on the right, we see earnings per share growth estimates by sector as of the end of 2019 in the gray here, compared to estimates now midway through 2020 in green. Earnings for technology was estimated to increase 10%, are now estimated to only increase 1%. Earnings per share growth for energy was anticipated to be up 20%, are now revised downward by 105%. So you can see how some sectors were hit harder than others. Here we see the annual returns of the S&P 500 in these gray bars. And in 2019, the S&P was up 29% for the year. But there was one point in the year that the S&P was down 7%, and that's the red numbers below. In 2020, there was one point in the year, March, where the S&P was down 34%. Then at the end of June, the market was down 3%. Not sure why it's showing 4 here. And now in the third week of July, we're seeing a positive number for the S&P 500 year to date. So what this chart shows us is that it's clear that the market is capable of recovering from intra-year declines and finishing the year in positive territory. And this should encourage investors to stay invested even when the market is choppy. This chart looks at high-frequency economic data to help gauge reopening efforts. Mortgage applications are 15% above normal, up from a low of 35%. Driving is way up at 36% above normal, up from a low of 47%. Seated dinners and restaurants have seen phased openings and closures. Hotels and flights are on the rise, but as you can see, not all industries are reopening at the same pace. The U.S. continues to have that pesky problem of income inequality. The overall income received by the top 10% of Americans is half what the other 90% earns. The chart on the right shows that while the top 10% receives more income, they spend much less of it, exacerbating the issue. So far this year, there has been $2.4 trillion in federal acts passed as a response to the coronavirus recession. The Congressional Budget Office has not yet updated the deficit estimate since the legislation was passed, but you can see a massive deficit in blue where JP Morgan has forecasted net debt to be 125% of GDP by 2030, previously forecasted at about 100% of GDP prior to the recession. The fiscal response was critical in keeping the economy in sort of a suspended animation as we learned more about the virus and its spread. And now as the pandemic continues to affect the economy, Congress is working to pass an additional bill. It will likely be similar to the CARES Act with more one-time checks, but this time for citizens with lower income, an extension of enhanced unemployment benefits, but probably not as rich as $600 a week, more help for businesses and state and local governments, as well as aid for school reopening. Hopefully in this polarized environment, a bill will be passed as likely neither political party will want to be blamed for a sinking bill containing so much needed relief. With low inflation and interest rates, JP Morgan says it's possible to retire the recently added debt, but it will really be contingent on how diligent we are about paying it down quickly and inflation staying low. I think we should be mindful with our votes so that when we elect officials, we elect people who are going to deal with the debt as soon as possible. It could be a tough outcome if the debt is allowed to linger and inflation increases. That would be a bad combination. We measure inflation using the CPI, the Consumer Price Index. The dashed line represents the 50-year average of 4%. Inflation has been well below the dotted line several years and dropped to almost zero this year. So we're seeing very low inflation. Looking at unemployment, the June numbers came in at 11.1%, lower than the analyst estimate of 12.4%. 4.8 million jobs were added back in over the month. What might the numbers look like in the coming months? JP Morgan is expecting slower growth than what we saw in June. One reason is that the PPP money lasts for 24 weeks. So as companies run out of funds, they can lay off employees without having to repay their loans. So we may see more layoffs in the coming months. Another issue is that more workers will be reclassified that were previously excluded. So an increase in workers may be offset by these adjustments, keeping unemployment above the 10% mark for the time being. Getting people back to work is critical for kicking the economy back in gear. The jobs report usually comes out the first Friday of the month, so mark your calendar for August 7th for July's jobs report. Bond yields are continuing to fall. All of the yields on treasuries have decreased from March 31st to June 30th. With the exception of the 30-year. Corporates down more than 100 basis points. High yield, asset-backed, floating rates, brutal. Looking over at the chart on the right, we see bonds issued in the first 5 months in 2019 in gray compared to the first 5 months of 2020 in blue. Falling interest rates and Fed action helped boost bond issuance in 2020. Look at the difference within treasuries, corporates, agency bonds. A lot has been going on in the bond market this quarter. The U.S., as measured by the S&P 500, was down 3.1% year-to-date June 30th. China was the only country in positive territory this year, up 3.6% in U.S. dollars. Europe, emerging markets, Germany, and Japan have all been regaining ground, but Brazil, Russia, India, and France are still having a tough go. The U.S. now represents 58% of the MSCI All-Country World Index, up from 55% a year ago. The U.S. has the largest slice of the tech pie, representing 27% of global market cap. Let's look at the spread of COVID in regions throughout the world. North America, Latin America, and Southeast Asia are seeing spikes in cases. Really concerning here in the United States. A vaccine couldn't come soon enough. On the other hand, Europe and North Asia seem to be faring better. Deaths have plummeted in Europe and are still climbing in Southeast Asia and North America. I'm looking forward to the day when we're on the other side of this. But this is a journey that we'll need to walk through together so that we can recover as a nation and a world. On the left, we have mobility data for developed markets. Japan, Germany, Italy, and France are all about 10 to 20% under normal mobility, while the UK is more like 40% under normal. Mobility in emerging markets show Russia, Taiwan, and South Korea pretty close to normal mobility, while several other countries continue to social distance. It's interesting to see how countries react to the pandemic. The Global Purchasing Managers Index is a leading economic indicator for global economic trends. A reading of 50 means there is no change, and that's the line right here. So readings above 50 represent expansions, and readings below the line are contractions. So the further it is away from the line, the greater the level of change. The services sector was hit harder in purple, but has recovered from a reading of 23 not too long ago. The gray line represents the manufacturing sector. Global GDP growth is down 1.7% this year, the first contracting year since 2009. A tough year for international. Breaking it down further, this is the heat map for the Global PMI Services Index, showing annual PMI by country, where most of the world came to a screeching halt in 2020 in red. These two columns show the last 2 months, May and June of 2020. In May, most developed and emerging markets were declining. But in June, many countries were beginning to accelerate, shown in orange and yellow. India, Brazil, and Mexico are having a tough time fighting the virus, and we saw their lower mobility metrics for these countries a couple slides ago. But China has both months in green, and we saw their positive results for year-to-date June. So I think these charts are helpful as we watch economies reopen. So what's in store next? We will be receiving some very important economic data in the next couple of weeks that should help underscore the depth of the recession. We have our eyes on August 7th for the jobs report, a key measurement. We should expect to see slower job growth in July than we saw in June, and brace yourself for the second quarter GDP estimate, which will be out July 30th. The third quarter GDP number will be key. Will it be positive or negative? That will help us see the length of the recession out the end of October. But even with GDP down 5% from the first quarter, down another 35% possibly in the second quarter, and up 20% in the third quarter like JP Morgan estimates, we are still down 7.5% for the year. So it will be a while before we fully recover through 2021, maybe 2022. We're also monitoring the next stimulus bill expected this August. But investors should keep their focus on the pandemic. COVID is the culprit holding the economy back, not the lack of a stimulus package. The disease has seen a resurgence, slowing the reopening process. Some countries are further ahead in corralling the virus, particularly in East Asia and more recently Europe. This should allow some countries to continue to reopen with less economic damage. Overall, the market has been resilient, but we could still see a correction before this pandemic is over. Well, congratulations for making it all the way through the third quarter economic review. And thanks to David Kelly and his team at JP Morgan for putting together such great resources. We can get into some really deep dives on the topic of finance and investments, but I hope the information presented in this video is easy to understand, that you can walk away with a few nuggets. So if you have any questions, please feel free to reach out to me. You can also connect with me on my Facebook page or on my website. Thanks so much and have a great day.